Hello everyone, it's yours truly, the Fxking. Now, if this is the very first time that you're seeing me on your screen, this is a segment of my YouTube channel where I literally come up here to make you understand what is going on in the forex market. Like, I come up here to break down the chart in order for you to make sense of what is happening within the chart. Because when you open the chart can be very the forex chart can be very complicated, very confusing, and very complex. So it is my responsibility to come up here to help you understand what is going on. How do I know that some of you don't understand what is going on? Because I could read your messages in the comment section of my previous videos where you guys are literally asking me to make a video that you want to understand what it is that is going on in the market so that you stop losing your money. And I thought of it, how best do you understand what is going on in the forex market without going through the proper channel of learning forex the right way? So it is on your request that I'm making this video. How do you trade forex the right way? How to learn forex the right way? I've divided this particular course into three equal parts. Number one part is what to know before trading. The second part is what you need to know during trading, and the third part is what you need to know after trading. Now, without wasting much of our time, let's dive right into the topic of today, which is how to trade the right way, or how to learn forex the right way. The number one thing I want to start with is what? The definition of forex trading. So what is forex trading? Forex trading is an art of buying and selling of currency in order for you to make profit from price differences. So three things are important in this definition. Number one important thing is that you are trading what? Currency. The second thing is that you are doing it for profit's sake. And the third thing is that it is in the price difference that you are making your profit. So what do I mean by price difference? Price difference, for instance, if the price of Euro USD is here, is 0.8, let's say 1.0509, you literally need a price to move from this point to point B in order for you to make profits. So that is what it means. Now this will lead us to the next phase, which I call what? PIP. So distance between point A to point B is calculated in pips. So what is PIP? PIP is percentage in price, which is the smallest price changes between different currency pairs. So PIP is what? Is the price changes between currency pairs. That is what? Your pips. Now the next thing I want to talk about is your what? Is your loss. As simple as ABC, what is loss size? Loss size. Loss size is used to determine the amount of money you are willing to put into the forex market. So we use loss size to determine the amount of money you want to risk when trading. It's as simple as ABC. So for instance, if you have $50 in your account, your trading account, how much of this money do you want to risk in buying or selling Euro USD? So for instance, you might want to risk maybe $5. So this $5, you will now convert this $5 and put it in loss size. So right now we are going to calculate, how do you calculate loss size in forex? So the first thing you need to know is that the least loss size is 0.01. The second one is 0.10. The third one is 1.00, and the fourth one is 10.00. Now 0.01 is equal to what? $1. 0.10 is equal to what? $10. 1.00 is equal to what? $100. And 10.00 is equal to what? $1,000. So 0.01 is equal to $1. 0.10 is equal to $10. 1.00 is equal to $100. While 10.00 is equal to what? $1,000. And all of these things is what? So for every zero, if you're using 0.01 lots, for every 10 pips is $1. If you are using 0.10, for every 10 pips, is $10. If you are using 1.00, for every 100 pips, so for every 10 pips is what? $100. And if you are using 10 lot size, for every 10 pips is $1,000. So now we want to calculate, let's say 30 pips. How much is 30 pips? 30 pips. How much is 30 pips going to give if we are using 0.01 and 0.01 in 10 pips is $1? How much is 30 pips going to give us? So using 0.01, we want to assume 30 pips. If 10 pips is equal to $1, 30 pips will give us what? We don't know. So we'll call this place X. What you need to do now is do what? To cross multiply. So this guy will multiply this guy, and this guy will multiply this guy. So you say 30 pips times 1. This is 1. So 30 times 1 will give us what? 30. 10 times x will definitely give us what? 10x. So you therefore divide both sides by the coefficient of what? X, which is 10. So divide both sides by 10. Divide both sides by what? 10. So 10 here will cancel this 10. Will leave us with what? X. So this 30 divided by 10, when you divide it, it will leave you with what? It will leave you with 3. So therefore, it means that X is equal to what? $3. It's as simple as ABC. So if 10 pips, if you are using 0.01, 10 pips gives us $1. 30 pips, if you are using 30 pips, 30 pips will give us what? $3. Now let's take another example so that you understand. So if you are using 0.10, know that every 10 pips will give you what? $10. Now if you are going for 50 pips, now if you are going for 50 pips, no longer 10 pips, what you need to say is that 10 pips gave you what? $10. 50 pips will give you how many dollars? You don't know. So you assume it is X because what? You don't know. Now what you do next is to cross multiply. When you cross multiply, this 10 will times this 10. So this 10 will times this X to give you what? 10X, which is equal to this 50 will times this 10, which is what? 500. So 50 times 10 will give you what? 500. So what you do is to divide both sides by what? 10. Divide both sides by what? 10. So this one will cancel this one. Will leave you with X is equal to this one will cancel this one. Will leave you what? $50. So if you are using 0.10, which will give you for every 10 pips to give you what? $10. So for 50 pips, this is what will give you $50. This is how to calculate it. So this is how to do what? To calculate it. And it's as simple as ABC. Let's do one more. So if we are using 0.50, so this is all we want to calculate now. 0.50 will now give us every 10 pips gave us $10 using 0.10. Using 0.50 now will give us how much dollars? So this is the question. This is what we are looking for now. In the same 10 pips, how much is it going to give us? 10 pips gave us $10 using this lot size. This lot size now 10 pips. How much is it going to give us using this 0.50? So all you need to do is just do your what? Normal what? Cross multiply, which is what? Like this. This one times this one times this one. So if 0.50 times 10, so all you need to do is just press your 0.50 0.50 times 10, it will give you 5. So 0.50 times 10 will give you what? 5. Now 0.10 times x will give you what? Equals to 0.10x. You understand? Because this is the number we are looking for. This is the price we are looking for, the dollar we are looking for. So 0.10 times what? This x will now give 0.10x. So when you divide both sides by the coefficient of what? X, which is 0.10, divide this one by 0.10. All you need to see, this one will cancel this one. This x will remain, which is x is equal to this 5 divided. So you now say 5 divided by 0.10 is actually going to give you what? 50. So that is that for that. So it's going to give you what? It's going to give you what? 50. So it's as simple as that. So if we are calculating with this one now, this is, I think this should be the last one. If we are calculating with this one now, we are saying, okay, since we know that 0.50 for every 10 pips, it's going to give us what? $50 for every what? 10 pips. Now we want to go for, let's say, 90 pips. Look for what? 90 pips. So we'll do this way. We say 10 pips gave us $50. So 10 pips gave us what? $50. 90 pips will give us what? 90 pips will give us how much? We don't know. That is what we are looking for. So it's the same mechanism. You just do what? Cross multiply. So 10 pips times this guy will give us what? 10x. This 90 times 50. So we say 90 times 50 will give us what? 4,500. 4,500. So we just divide both sides by 10. Divide both sides by 10, which is the coefficient of this x. So 10 will divide by this side. We are left with only what? X, which is equal to 4,500 divided by 10. 0 will cancel this guy. We are left with what? 450. So your answer literally is what? 400. And so for every 90 pips, so if you are using 90 pips, if you envisage 90 pips, 0.05 will give you what? Should be able to give you what? $450. Cool money. If you are enjoying what you are seeing, if you are actually enjoying this thing, or perhaps you don't know how to calculate point forex, put it on the comment section. Let me know that you learned something today. Let me know that you do what? You learn something. This is the easiest way to do what? Calculate. If you that way, check other videos of how to calculate lot size. Right? In other videos that you see online, I think this should be the easiest one that you can ever come across. If you've learned something, subscribe and what? Hit the like button. Let me know that you are enjoying this video right now. Now the next thing I want to talk about is that you must know that in trading the forex market, it is based on what? Speculation. Traders speculate that the price will move from point A to point B. Now, the next thing you need to know about forex trading is that the forex market opens 24/5. That means it opens on Monday morning till on Friday night. So it works 5 times in a week, 5 days in a week. That is when you can actually trade the forex market. So excluding Saturday and Sunday, you cannot trade the forex market. Okay? So the next thing I want you to know is a broker. Who is a broker? A broker is an agent who actually executes buy and sell order for you. So they execute buy and sell order. A broker, the work of a broker is like a middleman that executes the buy order and what sell order for their client. That is the work of a broker. Then the next thing you want to know is a spread. A spread is a difference in price at which a broker buys a currency for you and sells it to you. So it's literally how they make their money. So if for instance you are placing a buy order at this particular point, the broker don't actually buy at this particular point for you or sell at this particular point for you. Rather, they either buy from this point. So this is how they make their money. So from this place to this place is how they actually make their money. So it's the difference. It is difference between the price at which they buy the market and the price at which they sell the market to you. It's as simple as ABC. That is spread for you. The next thing I need you to know about forex trading is there's something we call an indicator. Indicator. So indicator is just like a technical tools on your chart. It actually, if you understand how to use an indicator, it helps like an additional confluence that you use to say, okay, this is one of the reasons why I'm buying, or this is one of the reasons why I have to sell. So an indicator is a technical tools on your chart that helps you to add more confluences as to the reason why you need to buy or to sell. So many people do not actually use indicator. I use only moving average. I don't like covering my chart with plenty indicators, because too much of these indicators will actually make you to lose a whole lot of money if you don't know how to use it. But if you know how to use it, that is fine. Now the next thing I need to talk about is time frame. What is a time frame? A time frame is a designated unit of time in which trading takes place. So as simple as it is, we have as low as seconds. We have seconds in time frame. We have minutes in time frame. We have a hour. That is your hour in time frame. We have your daily. We have a weekly. We have monthly, and we have yearly. So we have seconds time frame. We have minute time frame, like a 5 minutes time frame, 15 minutes, 30 minutes time frame. We have 1 hour, 2 hours, 3 hours, 4 hours time frame, 2 days, 3 days, 4 days. If it's in the 5 minutes time frame, it takes 5 minutes for every candle to form. If it's 15 minutes, it takes 15 minutes for one candle to form. If it's 30 minutes, it takes 30 minutes for one candle to form. It's on this hour. For every candle you see there represents 1 hour. Daily, for every candle you see on the time frame represents daily time frame. So also is the weekly, the monthly, and the yearly. So on the weekly time frame, for every candle, it takes 1 week for the candle to be formed. For the monthly time frame, it takes what? 1 full month for a candle to be formed. And so as also is yearly time frame candle. Now moving forward, the next thing on my mind is a type of trader. We have different type of trader. If you must know, all traders are not the same. So we have traders that scalp, so they call them scalpers. We have day traders. I'm trying to be fast, so I'll be able to cover a lot of things before we go for today. So we have swing traders. They call them swing traders, and we have position traders. Position what? Traders. Now, very quickly, scalpers are the type of traders who scalp. They actually use what? The lower time frame. The lower time frame, say your 5 minutes, your 15 minutes. They do the analysis on this particular time frame. That is your 15 minutes time frame, your 4 or 5 minutes time frame, and they execute their trade on that time frame. It therefore means that they don't waste a lot of time in the chart. They can place a trade now, and in the next 5 minutes they are out of that trade, either in loss or in profit. So scalpers, they enter the trade as fast as possible and leave the trade as fast as possible. Now the daily traders, what they do is that they can actually take 1 or 2 trades a day. They analyze the trade. They can use maybe the weekly time frame or the day time frame or the 4 hours time frame to do the analysis and execute their trade. As soon as they execute their trade, they actually allow the trade to hit their take profit or their stop loss during that particular day. So they trade for, let's say they start trading in the morning, and maybe at the end of the day they are done for that particular day, and the next day they find another opportunity in the market. Now the next thing you need to know is that there is more risk in scalping than in day trading, because in day trading you are just taking maybe 1 or 2 trades a day, and whether it hits your stop loss or your take profit, I think you are done for the day. But this one, because they are scalping, they can also scalp for like 4 times or 5 times a day. So the number of times you trade is not equal to the amount of money you earn. So there is more risk of scalpers than day traders. So day traders, they can hold a trade for maybe say 1 day. Then the swing traders, they can hold a trade for a couple of 4 to 10 days. That's they call them what? Swing traders. They can hold a trade, get into a trade, and leave that trade to run for as long as 10 good days or less or more. So you can now see the difference between. So there's more of less risk to this guy, because it takes maybe 1 trade or 2 trades and allow that trade to run for what? 10 days. But this one keeps trading every day. This one can trade today and tomorrow and next tomorrow. But this one can trade maybe 4 times or 5 times within a day. Then a position is as simple as that. Then a position trader is kind of an investment firm. What they do is that they go for the long term and not the short term. So these position traders, they can actually get into a trade and place a stop loss and allow the trade to run for like 2 months, 3 months, or 4 months. They are called what? Position traders. So there are advantages and disadvantages to this type of trader. I just need you to know that we have traders that are scalpers, we have traders that are day traders, we have swing traders, and we have position traders. So I believe that by now you should be able to know what the difference between day traders and the likes. So the next thing I want to talk about is market execution. So in order for you to execute the market, we have instant execution, instant execution. We have your buy limit, and also your sell limit. I will explain all this one so you understand. Your sell limit. We have your buy stop and your sell stop. So instant execution is saying, you are trying to say, I want to get into the market right now. So immediately you find an opportunity, you click your buy or you click your sell by yourself. But your buy limit or sell limit, or your buy stop and your sell stop, they are actually maybe the price of a currency, of a currency pair is actually trading at this particular point. But you need it to come back to this particular point for you to buy to the upside. So you actually use your what? Your buy stop. The same thing is with what? The sell stop. For instance, maybe you want to sell at this particular point, but the price is already at this particular point, is trading around this area. So you say to yourself, I need this price to actually come to this place and sell. I need this price to actually come to this place, and this is where I will want to sell. Now you place your what? Your sell stop at this particular point, and you tell yourself, once the market is coming, whether I'm around or not, let the trade be triggered. So you set so what you set here is what we call your sell stop at this particular point. So whether you are there or not, so long as you have already set it, once the market is able to come to this particular point, it triggers himself. But this particular one, you need to be there for this instant execution. You need to be there to execute it yourself. But these ones, you actually set it so that once it comes to your target, it either sells for you or buys for you. So these are what you need to know so long as forex trading is concerned. Now the next thing I want to talk about is there are many assets digital assets you can actually buy in the market. Just like we said, forex trading is an art of buying and selling of currency. So it's not only currency that you can actually, it's not actually currencies that you can actually trade in the financial market. You can trade other tradable assets like your what? Like your commodity. When we talk about commodity, we're actually referring, when we talk about your commodities, we're actually referring to your soya beans, your maize, your cotton, your coffee. So all these things are what? Commodity. They are also what? Tradable. And apart from commodity, you can also trade energy. When we talk about energy, we'll talk about your oil. So we'll have your US oil and or the other oil that we have. So you can actually trade your energy. So the next thing that you can trade your what? Metals. When we talk about metals, we'll talk about your gold and your silver. Okay? Your gold and your silver. So you talk about your gold, also talk about your silver. And apart from your metals, also you can trade your bonds. There are bonds here. There are futures you can also trade. There are many things that are tradable within the forex, within the trading market. So there are many things you can actually trade apart from what? Your currency. You can also trade your cryptocurrency like your BTC. So you can also trade your Bitcoin, your Ethereum. All of the cryptocurrencies are also what? Tradable. So you can actually trade them. Now, the next thing that you need to know about forex trading, let's dive right into the more technical aspect of forex trading. So the more technical aspect of forex trading is what I want you to know, that we have what they call bullish candle. So a bullish candle, and a bearish candle. So a bearish what? A bearish candle. So a bullish candle has to be what? Green. So they set the color, not that it has to be green, but most people, everyone sets it to be what? Green. So it has to be what? Green in color. Bullish candle has to be what? You set it as what? Green. And then bearish candle has to be red. So when you see green and red, your red means bearish, while the green means what? Bullish. It's as simple as ABC. That is for your bullish and bearish candle. Okay. Now, when you hear bullish, there are also terminology we use. When you hear bullish engulfing, for something to be bullish engulfing, when we say bullish engulfing, it means there was a red candle either at this particular point, So long as this candle is able to cover this candle, we therefore say that this is a bullish engulfing. So also we have bearish engulfing candle. Like bearish engulfing, maybe we have our green in this way, and all of a sudden we'll have another candle coming to this particular point to show us something like this. So we say this particular one is what? Bearish. Remember when I said bearish has to be what? Red, and bullish has to be green. So your bearish engulfing candle, this is your bearish engulfing candle, which has been able to what? Engulf this guy totally, cover this guy totally. So this is what? Bearish engulfing candle. And these are the things we'll be using to analyze our trade in order to enter a trade or not to enter a trade. Next thing I want to talk about is what we call chart pattern. There are about two chart patterns. There are many chart patterns, but two are very special to me. I call them the head and shoulder pattern. The head and shoulder. So because of time, the head and shoulder pattern, and the double top or double bottom. So the head and shoulder pattern is like this. So we say this is a left shoulder head, right shoulder. So once we see a chart pattern like this, on the chart, where most especially on a bigger time frame, so maybe the 4 hour time frame, day time frame, weekly or monthly time frame, it actually holds on a higher time frame. So we therefore say, okay, that this is a selling signal because we have a left shoulder head, right shoulder, and it has broken this neckline. Coming back to this particular point, what do we wait for? We wait for what? A bearish engulfing candle. So we wait for what? A bearish engulfing. Say the candles are forming like this, and forming like this. So all we need to wait for is to see something like a bearish engulfing candle around this area. Sorry, my marker is not working very well, but I believe you're able to see it. So wait for a green candle like this to close below these guys, and therefore we say this is what our signal. So this is a bearish engulfing candle using this particular head and shoulder pattern. So the next pattern I want to show to you is the next pattern I want to show to you is double top and double bottom. What is double top? Double top means that there was a candle here before. The market sold. The market attempt to come down to this particular place again and sold. We therefore say that there is something, that is why we say that. So therefore we say that there is something that is actually making this market to sell from a particular point, and therefore we call this place what? A resistance. However, before I move forward, let me explain what a resistance. A resistance is like a roof. This particular line can serve as resistance or can serve as support. So this particular line, if it's above, we say that it's serving as what? A resistance. Kind of when you throw your an object to the ceiling of your house, it bounces back. Now when it bounces back, what is pulling that object that you threw up is called a resistance force that is not actually allowing that your object that you threw up to either go beyond where you want it to go or otherwise. You understand? So for any reason why a candle comes to this particular point and reject, comes again to this particular point and reject, we say therefore that this is what? A resistance. So this line here, we'll call it what? A resistance what? Resistance line. It's as simple as that. So back to what? And also this particular point, we say that this is a support. We say this is a support because if for any reason the price of any currency pair was able to come to this point, and at this particular point it bounces off, it comes down again to this particular point, it bounces off. Therefore we say that this is what is support. Why? Because it's not allowing the price to break lower than this place. So this place is serving as what? A support. So we actually have support line or support zone and a what? A resistance zone, or a support line and a resistance line. Okay, so back to the chart pattern I was talking about. I've been able to explain the head and shoulder pattern, and I was explaining this particular double top before I got to know that I needed to explain resistance and support for you. So you now know that the resistance, for you to hear that something is resisting, whenever the price comes to this place, it's reject. Whenever the price comes to this place, it's reject. So we say this is what? This particular point is our what? Resistance level. Then this particular point we say is a support level because whenever price comes to this place, it bounces off. Whenever price comes to this place, it does what? It bounces off. Therefore we say that at this level, there's actually something at this level that is making the price to bounce off of that level. So without further ado, that is your support and your resistance for you. Then I will also explain these two patterns. So this is double top, and also this is what? Your double bottom. So the price is able to come to this place. So for a reason, the price came to this particular point and left this particular point. All of a sudden, it came back again to this particular point, and the same thing happened. The price was also able to what? Push up. So for this reason, this is our patterns that we use in what? In trading. So the most two efficient used pattern are the head and shoulder pattern and the double top, your double top and your double bottom. Okay, so this is double and this is what? This is double. So that is what it means. The next thing I will talk about is what they call take profit and stop loss. So how your stop loss, and what? Take profit. Mind you, this particular video is part 1. So after this video, after you watch this video, you have to watch a part 2 of this video. Okay, so what we want to talk about now is stop loss and take profit. What is stop loss? Stop loss is very easy. It means stop loss. That is what it means. For instance, if using your loss size I will explain, you want to use $5. You want to use $5 to buy a particular currency, say your Euro USD. And for instance, your stop loss is at the end of this candle here. Now this is your stop loss. It therefore means that you say, okay, I have every reason to buy this candle, to buy this price at this particular what? At this particular point, okay? I have every reason to buy this price at this particular point. But however, you know, trading is a game of probability. So if you are correct, most of the times you make money, but if you are not correct, most of the times you lose money. So you are saying that, okay, I want to buy at this particular point, or rather I've already bought at this particular point, but I have to put something here that I'm only risking $5. I don't want to risk more than $5. And at the end of the day, that if the forecast did not go according to my direction and the market reversed and come here and hit me, I want to lose only $5. That is what it means. Stop me at $5. So you actually set it. Stop me at $5. Stop me, or maybe it's okay, I want to use only $10, or you want to use $100, depending on the amount of money you are trading with. Okay, so you are saying stop me at this. I don't want to risk more than, for instance, you have $50 in your trading account. It will not be wise for you to use all of this money to buy a particular currency or sell a particular currency. Why? Because you might lose even before you start gaining. So the wise thing to use is either you use your 3% or use 2% of this money. Okay, use 2% or 2% or 3% of this money. For the purpose of this trade teaching, I'm just using, let's say, $5 from this $50. So if I'm using $5, I'm saying I don't want to risk more than $5 at this particular place. So if the price goes against me, let me lose only $5. That is what? Your stop loss. Then your take profit is also, okay, I've anticipated that this price will move from here. Where do I want to take my profit? Where do I want to say, okay, once the price is able to get to this particular point, I'm okay. It's as simple as that. So when the price actually comes to this particular place, you say, okay, take me out on this particular area. Okay, sorry for the drawings, I'm just trying to be fast. So it's as simple as ABC. So why you have your stop loss below, depending if you are buying, you have your take profit what? Above. Okay, for a buy. Okay, for a buy. So if you are selling from here, it means your stop loss has to be here, the take profit has to be here. So the next thing I'll be talking about is, so the next thing I want to talk about is phase. We have 3 phases in forex trading. As long as forex trading is concerned, we have 3 phases. Number 1 phase, we have the bullish phase. We have the what? The bullish. The bullish. Number 2, we have the bearish. And number 3, we have the consolidational phase. So we have the bullish phase, bearish phase, and consolidating phase. Consolidating. So it's just what it is. Bullish phase means that bullish trending. Let me call it bullish trending. Bullish trending phase, bearish trending. So we have bullish trending phase, bearish trending phase, and consolidational phase. So all of these are what? Phase. All of these are what? Phases. Okay? Okay? So bullish trending phase means that the market has to be in an uptrend. So this is what bullish trending. The market is moving in an uptrend. Okay? So you can also call it uptrend or bullish phase. Then your bearish phase is that the market is moving in a what? Downtrend. Okay? So the market is moving what? So this is your bullish phase. This is your what? Bearish phase. Okay, the next phase is what? Consolidational phase, where the market is just moving up, down, up, down, up. So you can see what the market is doing at this particular point. It is not going up, it is just what? You can also call it ranging. So it is just what? Ranging. So this is what? A ranging phase. So you want to enter into the market when the market is actually at the point of what? Going to the upside, or at the point of what? Going to the downside. This consolidational phase, you don't have to trade at this particular phase, because this is where most traders loses their money, because the market is what? Consolidating. So guys, the next one I want to talk about as fast as possible, so that we'll be able to cover a lot, because there's a lot to cover. Like I said before, this video is going to be too long, so I want it to be part 1. So watch out for the part 2. If you're enjoying this video, let me know in the comment section. Let me know in the comment section. Let me know. If you're enjoying this video, let me know in the comment section. Subscribe and let me know in the comment section. The next thing I want you to know is also one of the most important things, so long as it has to do with trading. If you're not able to determine the structure or the direction of the market, you're going to have a lot of problems. So for beginners traders, or for those who do not actually know how to trade, or you have been trading for a while now but you have not been able to make money, this is the reason why you have not been able to make money, and I will show you for free. This what I'm about to show you now is what most traders, most gurus out there, they charge you for. Okay, they charge you for this because it actually takes a lot to be able to learn this. So when they learn it, or when they know it, they want you to pay for it, but I'm giving it out for free. So there are actually two things you pay for. So when you pay someone to teach you forex, you are paying for what I'm teaching you. So this is called a course. Okay, so this is called a course. Then the second thing you are paying for altogether is the mentorship. But the mentorship is another aspect where you actually need to be shown all these things. Like for someone who has not been trading for a while, or who has no idea. For someone who has no idea about forex trading, so you actually need someone to hold you by your hands and tell you to do this and do this, do this and do this on a consistent basis. And over time, you begin to understand what is happening in the market. So when you are paying someone, do not actually pay just for a course. I want you to teach me, because most of this is you can get it online. Okay, but the most important thing is mentorship. If you have someone who is able to mentor you, then the person has succeeded in helping you shorten the period of time at which you are going to lose your money. Because if you have no experience in forex trading, bet me or not, you are going to lose a lot of money. So the work of a mentor is actually to help you understand these things over and over and over a period of time. Okay, so what I'm about to teach you now is very important, so you guys should pay very good attention. So how do you know that the market is going to buy? Or how do you know that the market is going to sell? Okay, how do you know? How do you know? So it is what we call structure of the market. We call it structure. Structure of the market. Okay, call it structure of the market. So you actually have to understand the structure of the market. If you do not understand the structure of the market, then you are going to not be profitable in forex trading. So what is the structure of this market right now? Okay, so like I said before, this is a bullish trending phase, or an uptrend. You call it an uptrend or bullish trending phase. Okay, so what is the structure of this market? The market is making, this is a high, this is a low, this is a low, this is a high, this is a low, this is a high, and so on and so forth. Now if you watch very closely, so we'll call this a high, a low, a higher low, and a higher high. So what we call this part HH, we'll call this part HL. So this is a higher, this high is higher than this high. So therefore we say this is what? A higher high, because it's higher than this high. Then this low is higher than this low. So we'll call it what? A higher low. So this is what, how you know that the market is what? Going upward. Okay? So this is basically how you know that the market is going upward. So we'll have our H here, HL. So guys, what is the meaning of HH and what is the meaning of so let me know if you are learning. What is the meaning of HH and what is the meaning of HL? HH means what? Higher high, and HL means higher low. That is how you know that the market is what? Going up. So what do you do? Now, in this particular phase of the market, what you then look for is a point, or what I look for is a point where the market now has to give me, since it's a bullish trend or a bullish trending phase, I will now look for double what? Bottom. You guys now know what double bottom is. So for instance, I will need this market, for instance, let me put it here. So let's say this is a high, this is a low. 1, 2. Okay. So now remember the two things I explained. If you want to buy or sell, there are two things you have to look for. Sometimes you look for the chart pattern. You look for a bullish or bearish engulfing candle. You look for resistance. You look for trend line. You look for your indicator, maybe a moving average. So these are 4 or 5 things you put together. Once you're able to put these things together, then you will now have reason that based on these things I've put together, the market is going to buy or the market is going to sell. So what I therefore look for, if this market is going up, what I therefore look for, I will want this market, since I know that this market is in a bullish direction. So the number one thing you need to know about structure of the market, you need to know what the direction of the market for you to be able to buy. Okay, you need to know the direction of the market for you to be able to buy. Now, since you know that the market is in an uptrend, all you'll be looking for is buying opportunity. You will never have to look for selling opportunity in a buying market. It's just like catching a falling knife. Once you want to catch a falling knife, it might slice your hand. Number one thing you need to look for is what? The direction. So how do you look for the direction? Direction of the market. Now, you have been able to determine that this is uptrend. The market is going up using this higher high and higher low. So the market is going up. So this is the direction. The market is going up. The next thing you want to look at, I want to buy this market right now. This market is behaving like this. I want to enter this market. Well, how do I enter? You have to wait for, some people call it immediately the chart, the candle break this particular point. Some people call it break of structure. They call it what? Change of structure or shift of structure. Personally, I don't call it break of structure or shift of structure. Rather, I can even call it shift of structure leading to the continuation to the upside. So I don't call it a change of structure, so I start looking for sell. No. The market has to come to this particular point, and once the market is able to come down to this particular point, now it is now a kind of double what? Double bottom, what we talked about 2 chart pattern you need to use in buying or selling. So the market now has given us double what? Bottom. And at this point, this is now my area of interest. So this area of interest now, I'm saying, okay, this market is in what? It's in an uptrend. The direction of this market is going up. Therefore, I'll be looking for my buys. Now, this market has been able to what? Come down here using my strategy. This market has been able to come down to this particular point, giving me what? A double bottom. So now I have direction uptrend. I have the direction to be what? Direction uptrend. Now, chart pattern, it has given me what? Double what? Double bottom. So that is number 1. That is number 2. So number 3 now, and I have a bullish engulfing candle. Say the candle has to come around this area for a red. And the next thing I saw at this particular point is a green candle that is bullish. It is a confirmation giving me what? Number three, bullish engulfing candle off of this what? Resistance support bar here. So I have bullish. And peradventure I have my moving average. That is number 4. I have my moving average kind of coming around this area to hold this particular point. So I add my moving average to this part. Moving average at this particular point. So I have my what? Move. So I'm having the direction of the market is up. I'm having double bottom at this particular point. I'm having bullish engulfing candle at this particular point. I'm having moving average at this point. And number 5, I can have my psychological level at this particular point. Maybe at this particular point I have 1.0500. So it's not like a scattered number like a 4134. No, I'm having a 0.500 at this particular point. Okay, at this particular point, this is what I'm having. So I'm saying, okay, this is like kind of a round number. So I'm having 5 things: direction, double bottom, bullish, moving average, psychological level. So tell me the reason why I should not take a trade at this particular point. Tell me the reason why I should not take a trade at this particular point. So this is for what? Your bullish trend. Now, for your bearish trend, it's also the same thing. It's also the same thing. So the market has to be come like this, do 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 like this. Okay? So at this particular point, this is a what? A high. This is a high. This is a high. This is a high. This is a high. Huh? This is a low. This is a low. This is a low. This is a low. So this point, this high is lower than this high. So I call this one lower high. But this low is lower than this low. I call this one lower low. So this is a low, this is a high. This is a lower high because why this high is lower than this high. This high is lower. So this is what? A lower high. This is a lower high. This is a lower low. This is a lower low. So this is how you know that the market is what? Going down or heading south. So it's as simple as that. This is how you know that the market is what? Going to the downside. Now, since I've been able to determine that the market is going to the downside, if you want to enter this particular trade, what do you look for? Some people will say, okay, once I have this candle, come to this particular place, break this particular point, it is now a change of structure. No, I personally do not call this a change of structure. Why? Because the market can come to this particular point, hit this particular point, and do what? Head to the downside. Now, let me take you over to my screen. Now, the market can come to this point, come to this place, and now start going down. So the fact the market broke this first particular point, it's not a change of structure for me. It is just a shift of structure leading to the what? Leading to a continuation to the downside. I don't know if you understand what I'm saying. So as a beginner, this is all you need to know about forex trading. So I want you to lose money because I've been doing this for 4 years, and for that 4 years, I've lost a whole lot of money until very recently this year, where I now become very profitable, and that is why I'm able to stand in this position. I want to bridge the gap. What I did not learn on YouTube, I'm giving it to you for free. This particular pattern I'm teaching you, you cannot get it in YouTube. Because why? Most people will tell you that this is a change of structure, so you have to be looking for buy opportunity here. This is not a buying opportunity. It's not a buying what? Opportunity. So what I dare look for, I will therefore wait for the market to what? Break this particular point, come to this particular, the next high. So I will look for the market to come for the next high. So it is now at this particular point. I will therefore look for what? Bearish engulfing candle, red bearish engulfing candle that perhaps, so this place has to be green. This is, let me assume that this is the last green candle that comes to this place. This is black now, but I'm using black color. So let's assume that this is the last green candle that comes to this place. So all I'll be looking for is bearish engulfing candle like this. Once I've been able to see this, now this is my trading style. This is my trading approach. This is how I trade. So therefore, I've already seen that the market broke this particular point and came to this particular point, and the direction. So the number one thing I want to now talk about is the direction. So I know using this lower high and lower low, I therefore know that the market is heading what? South. So since the market is heading up, so number one thing is the market is what? The direction of the market is what? Going down. So the number two thing is that the market was able to break this point and come to this place. So that is my number two. So number three is that I have a bearish engulfing candle off of this particular point. So number four, I'll now be looking at like, okay, there was an average, moving average around this particular point. Maybe number five thing, I will now be looking for psychology. So I have to see about 5 reasons at this particular point why I want to sell this particular point. And most often than not, 7 or 8 times, your market will actually go in your direction. So it will actually go in your direction. Why? Because you are doing the right. So even when I say a bearish engulfing candle here, and the market tends to break above and break and close above, ladies and gentlemen, believe you me, it therefore, because I believe in this my strategy, it therefore means that my first analysis was wrong for a sell. Now the market has moved to a buy. So I will therefore be looking for a buying opportunity. But most people will call it a reverse trade. It's not a reverse trade if you know what you are doing. Okay? So that is that for that. So I believe now you understand what structure of the market. That the market, so when you talk about structure of the market, we're not talking about the phases of the market. Okay? Ladies and gentlemen. Now the next thing I want to talk about, how do I know reversal? How do I know that the market has now reversed? That if the market was going in an uptrend before, that the market is now what? Heading to the downtrend. Now, if you want to look for reversal, 3 things I consider. What does it? 3 things I consider. 1, because I know that at this point, this is one, this is a low, this is a low. Right? So this is a higher low, a higher low. Okay? This is a high, this is a high. The market has to first of all come to this particular point and break this place. So number 1, I've seen a break of structure. So this is now when I don't confirm break of structure around this area. This is now a break and close. So the market has to, the candle has to literally close above this place. So once the market closed here, I therefore say, okay, number 1, change of structure has happened, which is what? A low. So the market is now heading, the direction of the market is what? South. So number 1 is the direction of the market. Then I therefore wait for the market to be, at this particular point it is low. You don't actually sell when the price of a particular currency, or even when you go to the market, live market, like you want to go to your market to buy food items, you do not, or rather you want to go to the market to sell your food items. You do not sell your food items when the price of that particular item is low. You wait for the price to be high so that when you sell that particular item, it becomes of good profit and gain to you. When they say the price is here and you are selling at $20, but the price can come to this particular point, which is $100, and when you sell at this particular point, you make more money. So why sell $20? Why you can wait for the price to come to this particular point high so that you can sell? So you don't sell at a low, you sell at a high, and you don't buy at a high, you buy at a low. I don't know if that makes sense to you. So guys, you can see all the energy I'm putting in so that you understand. So now I know that the market is doing what? The market is selling. Okay? Sometimes I will allow the market to, since this is a low, right? I want to see, since this is now a low, okay? I want to see a high, okay? At this point, I want to see a low. Then I want to see this market come and close above this particular high. Okay. Guys, what I'm teaching you, you cannot see this thing on the internet, because this is the secret why most people are losing and why some are doing what? Are gaining. This is how I trade, and this is how I make money off of the market. Some people, because you have already determined that this is a sell, you start selling immediately, and maybe your support will not be above, so it keep hitting you. Even when you see that this market has given you a high, this high is not high enough for me, so I want to see. So two things are involved here. Is either the market comes here, gives me this high, give me a low, takes this guy off, and give me a bearish engulfing candle at this particular point. At this particular point is where I start what? To sell. So I have confirmation. This guy is a sell. This guy has been able to what? Take this particular candle off, strip to, like they call it liquidity. Induce buyers, so that buyers will start buying. Change your structure. Buyers will start buying. I say no. For me, it's not a change of structure. So this place is now a change of structure, because it has been able to break this 1 and 2. Now this is a high. I will not sell this high. I wait for this low, and I wait for this low to now give me a high. So this is a high. So I will now wait for this. It is now at this particular point that I look for what? Bearish engulfing candle. Once I get this bearish engulfing candle, ladies and gentlemen, 9% out of 10 it will hold. So this is at this point that I start selling. So if you watch very well, it's like a head, shoulder, a left head, shoulder, right. Okay? Does it make sense? Does it make sense? If it makes sense to you, let me know in the comment section, okay? Let me know in the comment section. So I'll actually wait for the market to come here, do something like this. So now I've gotten my left head, left shoulder head, right shoulder, and the market will now come, start heading to my direction, okay? Now, if this does not happen, I will therefore look for something around this area. Maybe before this market was able to break to this particular point, it has given me something around this place, maybe here, right? Here, before it broke. Okay, so on breaking this particular point, I would therefore need this market to do what? Come back to this particular point. If you understand what I mean now. So at this particular point now, I now have what? Double top at this particular point. So the market came here and sold. The market came here and do what? Give me a bearish engulfing candle, adding it to the fact that it was already selling at this particular point. So this point are already selling. I'm not going to sell at this particular point. I'm only going to wait for a high. So at the high, how am I expecting how high do I expect the market to go before I start selling? These are the things I look out for in the market before then I start selling. So with this, 9% of the time you actually make money, 9 out of 10%. So it's as simple as ABC. So ladies and gentlemen, the next thing I want to teach you is how do you read the structure? How do you read the structure of the market? How do you read the structure? How do you know a low, a high? For instance, this what I just drew here is very easy. Sometimes you don't see it in the market like this. It's so linear. Sometimes you don't see it in the market like this. And this is where it now becomes what? Very complicated for most people to read the chart. For instance, ladies and gentlemen, if I have a low here, okay, and I have a high here, I have a low here, I have a high here. Most people will say, okay, this is a high, this is a low, this is a high, this is a low, this is a break of structure. I said it's not a break of structure. It's not what? A break of what? Structure. So all I need to do, before you know what is happening, the market will therefore sell off. So if you are thinking that this place is a break of structure, and you are thinking of buying from this place, maybe stop loss around this place. At the end of the day, you see the market hit your stop loss and keep going downward. So you will only buy at this particular point and sell at this particular point. What I'm teaching you now, like I said before, you will not see it on the internet. Why? Because it is what makes your mentor a mentor. But I'm teaching it for free so that you guys will not lose money again. So what you need to do at this particular point is, so this is a high, this is a low, this is a high, this is a low. This is not a break of structure, this is a high. So now the high now has changed from this point. So I call this a high, a low, right? Or sometimes you might even see it like this. Might come down like this. So now give you a low, I'll give you a high, okay? A low, a high, a low. Okay. Now, the only how you will know that this market is going to reverse now. What I'm teaching you now is what I now call reversal. How do you know that the market is now going to reverse? From the market that is buying, it's no longer buying, or the market that is selling is no longer selling, it now wants to buy. Now you have seen this. So now this was a high, this was a low, this was a high, this was a low. This is now a high. This is a low, this is a high, this is a low. So therefore, I now start counting again. So this is my high, this is my low, this is my high, this is my low. If this market, remember what I told you, this market has to come, sometimes this market will come to this particular point, at this particular point, okay, and sell, keep going down. But if it doesn't do that, wait for the market to do something like this, break this particular point. So you can see what I have explained this in before. So it has to break 2 times, not just once. You see, this is a change of structure. It's not a change of structure. The market has to break 2 highs before you now say, okay, this is now a break of structure or a reversal pattern. And therefore, this market, after break and close at this particular point, do not buy at this particular point because you know it's already buying, or because Fxking said once it breaks this place, it's a buy. Do not buy at this particular point. Why? Because it's too high to buy. When you want to buy something from the market, I know everyone wants to buy it at a cheaper cost. So wait for the price to be low. Now, how do you want the price? Where is the area of your interest? Now you have to have the area of interest. So the area of my interest is at this particular point. Now this low is, now when I started trading, I don't know that there are some lows that can be protected. And when you put your stop loss there and you are right in your direction, the market will never come to that particular point. I was not told that, because I was hitting stop loss everywhere and anyhow. So at this particular low, this low is protected. This market can never, if this market is actually going to go up, this market will never come down to this particular point. So this is the point at which you put your stop loss. So this is your stop loss area. So you wait for this market, after break and close above this area, wait for the market to do something like this, let the market come down around this area, gives you a bullish engulfing candle at this particular point. So you now wait for what? A bullish engulfing candle. So you now add it that this place has already told you that the market is going to buy, or the market is already buying. Now this is another confirmation at this place that the market is already buying, because it gave you a bullish engulfing candle, adding it to the fact that this is left shoulder head, right shoulder. So you can see the combination of confluences as to why we are buying. So you're not adding it to that. This is left shoulder, left shoulder head, right shoulder head. So you now have chart pattern at this place. So you have chart pattern. So you say 1, direction of the market is uptrend. So 1, uptrend. 2, chart pattern. 3, bullish engulfing candle. So 4, maybe you have your moving average. 5, psychological level at this particular point. And ladies and gentlemen, the market will rally all the way so it gets to where it wants to start heading down again. So the market is not linear. The market is not linear. That is why most people make mistakes. So one of the ways you cannot become profitable is what I just taught you now. What do you do? Know fully well that this is what. Know fully well from here. When you are reading your structure of the market, know fully well that this is a high, this is a low, this is a high, this is a low. There can be a high above this particular high. Does not technically mean that does not change structure. It only change structure if it's not able to close above this particular point. That is just the point that I'm trying to make here. Okay, so when I have it here, a high, a low, a high, a low, a high, a low, a high. So it just keep going and keep going. Okay, so when you are looking at it, look for. So in summary, when you are looking at change of structure, that you need to see a change of structure, you already know maybe this thing is going to buy. So it's already giving me a buy scenario. And how is it going to give you a buy scenario? It's like this. Okay, it's like this. It's like this. So it comes here, do like this, comes here, do like this, boom. So at this particular point now, you say, it has broken, Fxking said, it has broken 1, 2. So when it breaks here, some people say it's change of structure, they start buying. No, it has broken 1, 2. It has broken 1, it has broken 2. So this is now what? A buy. But this buy is too high. I need the price to be low. And what am I now looking for? I'm looking for the price to at least come down to this particular point and this particular point. So it's always aligning with chart pattern. And at this particular point, I look for bullish engulfing candle where I start buying for the upside. So guys, these are ways, things you see in the market before you can enter a buy or a sell. Now, in my next video, ladies and gentlemen, I will be explaining more in details about this structure of the market. So in my next video, I will be explaining more about this chart pattern, structure of the market, so that you understand it in depth. In my next, that is the part 2 of this video, and it is in that video I will not talk about. Remember when I started, I said that I've divided this market, learning how to trade the right way. I've divided it into 3 parts. The first part is what I'm teaching, what you need to know before trading. There's something, the next part, which I'm going to talk about in my next video, is what you need to know during trading and after trading. And in that part, I also explain more of this structure of the market, and it's also in the next video that I will talk about how to use the MT4. So in the next part I'll talk about how you use your MT4 or your MT5, everything about your MT4 and MT5, and how to choose your broker and everything. So it is actually in the next video that I'll be able to break more of this structure down, talk about what you need to know during trading and after trading, then talk about how to place your trade. So ladies and gentlemen, if you enjoyed this video, or you're able to catch 1 or 2 things in this particular video, do yourself a favor by subscribing, so when I release the next video, you'll be able to get the full gist about learning how to trade like the Fxking. And also like and comment. Tell me what you learned about this particular video on the comment section below, and see you in the next video. Peace.